Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The Dow had a big meltdown. He comments on crude, lumber, the Canadian dollar, and gold. Ross also has a special offer for our listeners. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, checks in from San Diego to talk about California and the U.S. real estate markets. He also looks at how inflation could affect real estate and the stock markets. Ed Steer from EdSteerGoldandSilver.com digs deep into the precious metals and what he feels the outlook is for gold and silver. Are high coin prices predicting the future of bullion? Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsBy. Ross, welcome back to This Week in Money.
Pleasure to be with you, Jim.
Ross, with so many records either falling or being set, it's important to stay on top of the big items that are moving the markets, and you have a special deal to help people do that.
Yeah, well, what we're doing, we're offering people 25% off the annual subscription and the opportunity for a $200 trial subscription. And to give people a feel for what we do, not just, the conversations that you and I have, but I put together one file that has our recent research that I've done on gold, crude oil, the S&P, lumber, Canadian dollar, soybeans, and just how we identify significant points of exhaustion and capitulation recently here to get the turns on these markets. And this has been a pretty exceptional week on things, the way things have come unglued, right along the lines of what you'd expect after the excesses that we saw during April or during May and the first half of June. So they drop by the website, click on the request there, and we'll send them out some research so that they can take a gander at it.
The major stock markets in North America really took it on the chin this past week.
They did. This, a lot of pieces fitting into the puzzle here. Now, the FOMC is the excuse and the catalyst for the dollar to take off and then everything else to drop, with the exception of the crude oil market. But, these markets had been setting up with vulnerability. The seasonality aspect that we look at on the S&P as you move through this post-presidential year, we wrote a report in the last week saying that we should be topping out 20 to 25 days after our oversold signal here that we had at the beginning of May. So the optimum window was this week. It topped on the 22nd day on Tuesday. The reversal is right where we'd expect to see it happen. And the degree to which it sells off right now will be pretty important in terms of the outlook as we move into July, August. The bigger picture is one of quite a rolling top up in here. And we see that not only has the Dow managed to take out its May lows right now, but also the transports are way ahead in terms of breaking down. So that's not looking very healthy from a Dow theory point of view. The other thing is what has been termed Dr. Copper, and that copper has been a good indicator historically around market highs. And the way we look at it is based upon the monthly copper chart And when we go all the way back to the 1960s and 70s and come forward, there have been 10 examples where there was a sequential sell setup. 7 of those, the S&P dropped in the coming months down to its 50-month moving average. 3 of them had dropped down to the 20-month moving average. And that's quite a ways below where we are right now. The other thing that we saw in copper was the upside trifecta. That's what we call it when you get overbought on the daily, weekly, and monthly charts, and that was around the second week of May. So when you get the sequential together with the exhaustion signals that we've got, the probability here is that we are going to have one of those hard breaks, types you've seen, say, 10 times. And second half of the year, the optimum would be that we break by a minimum of 15%. So looking for the second half of the year to be fairly disappointing for long-term investors.
Lumber has taken a tumble.
Yes, lumber prices have now dropped in half. I mean, $1,700, we had the exhaustion signals that we look for, and now on the weekly chart, we're finally getting oversold. So, probably going to get some kind of a bounce out of here, but, that's a very thin market. It's not for the faint of heart, and we've been looking at it as potentially pulling down also the stocks such as the home builders and the companies like Home Depot and Lowe's that provide a lot of the materials that go into the homes. So at this point, lumber is probably going to thrash around a lot, and I don't think that there's going to be a major new trend in there until it's done a lot of backing and filling. So the easy part of the trade was the one to the downside, and I think that's now behind us.
Despite grains and crude being higher, the Canadian dollar has lost about 3 cents from its high. What's the story there?
Yeah, so Commitment of Traders numbers, we put out a special report on this a few weeks back when we were up at 83 cents. Seeing excesses as far as the speculators were concerned on the long side for 2 weeks in a row. We also got exhaustion signals on our weekly charts. And then as things started to roll over, they've gained some real speed on the downside this week. We're down, I guess, 3 cents now off the high. And we're of the mindset that the Canadians been in a consolidation phase for 5 years. This was a pretty good breakout to 83. We needed a correction. So somewhere down in the 79 cent level or under, probably start to look for it to try and base out down there. And it's hard to say how that's going to reflect with the U.S. dollar. The dollar index just took off as soon as the FOMC announcement was made midday on Wednesday, and that's when the Canadian really started to take it on the nose. But this, I think at 80 and a half where it is now, there's maybe another easy cent on the downside, and from there it could become interesting again.
What's going on with gold?
Well, this is another one of those items that really has been just so good for us. We caught the original lows under 1,800, then had this nice rally. Upside exhaustion signals a couple of weeks ago. We ended up with an outside reversal week, followed with daily and weekly sequential signals, and when we were at $1,900, we had upside exhaustion. So the minimum we were looking for was a move down to 1,800 to 18 and a quarter. And as of the end of this week, we finally got the first oversold level in gold that we've seen since it was back at the 1683 level. So gold's going to be really interesting going along here. We've got some short-term guides that we use for finding interim lows, and the big picture, if we look at it, is a saucer pattern here from 2011 to where we are now. It's a big saucer if you look at it with a little handle on the end. Just the same thing that happened during the 1970s. So this could be building a significant base as far as gold is concerned, but we'll have to watch the daily and weekly charts to come up with a new signal like we did when we were down under or in that 1680-ish range. So definitely one of the items that works well for us.
Ross, can you remind us again about the special offer?
Yes, 25% off the annual subscription for new subscribers or a $200 trial. And there is that file that you can request, which will show you the research that we have done recently on a fairly broad number of markets.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Robert Campbell, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter online at realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money.
Thank you very much. Always look forward to these, to our monthly talks, Jim.
Bob, what's the latest on the Campbell Real Estate Timing Letter, and do you have any upcoming events?
Yeah, well, in fact, let's do a 30-second, commercial first. I mean, one of the big highlights for me right now is I normally give 2 to 3 seminars a year at the La Jolla Marriott, and that's been shut down because of this COVID thing. They just contacted me and said, Mr. Campbell, when are you going to come back and do seminars? And they said, we're open. And I go, I'm ready. And I said, I only have 2 requirements. And they said, what's that? They said, no masks and no vaccinations required. And she goes, after June 15th, we're a go, Mr. Campbell. So I set my first date in almost a year and a half or more at October 23rd, 2021. Where I get to see live people, where I get to perform in front of live people again, which is always just so much fun and so interesting and so rewarding for everybody. But what I do, for those of you guys that don't know me, I wrote the book Timing the Real Estate Market back 19 years ago, 2002, and that led to me writing a real estate investment letter called the Campbell Real Estate Timing Letter that uses all the key indicators that I describe in my book and a few more that I've learned about in the last 19 years, and put together a real estate timing model that tends to be highly accurate, usually in the 80 to 90% range. So I'm real proud of that, and it's a way of staying ahead of getting into good markets early, getting out of bad markets early. So, and that's at realestatetiming.com. So that's what's doing my life. This seminar I think is going to be good. And I think what I'm going to be talking about I'm sure what we're going to be talking about today, guys, is a lot about inflation. I'm thinking, okay, what's a timely topic? It's got to be inflation. Of course it's inflation. I'm 74 years old. I lived through the 70s and the early 80s when we had inflation here in the United States and what it did to the economy and what it did to real estate. So there's nothing like first-hand experience. Plus, I've studied it, guys. I have a degree in economics from UCLA, even though the best thing that came out of UCLA was my volleyball skills.
Is inflation the elephant in the room?
Yeah, it's a real good chance. It's really good that's the case, guys. Very good chance. Now, everybody should know that follows me. There's no certainty in anything. Everything's probabilities in life. Nothing's ever completely black or completely white. It's all about probabilities. So all you can do is just look to the past to help predict the future, and look at today's market conditions, what people are doing with money supply, what the existing trend is, and then look back in history and see what happened and said, is that possible this could happen again? And you go, you're damn right it's possible.
Is there an inflation cycle?
You know, and that's why I'm thinking that I think this is going to be an inflationary cycle. We haven't had inflation since the 70s and early 80s here in the United States. So let's just say it ended in 80, so that's in 40 years. I mean, inflation is a real thing, and it devastates economies, and it happens, you know, all the time at different places. So why would we be immune to that cycle? So we very much well could be into another inflationary cycle. You know, that if you live long enough, you see everything, right? I mean, most people aren't old enough to even remember what happened back then. But it's really interesting what happened, because inflation took off, and it started slowly in the 70s and gradually built up to a crescendo where the U.S. dollar, the world reserve currency, lost 50% of its value, and the Treasury or the Fed chairman at the time was a guy named Paul Volcker. To save the dollar and save the U.S. economy, from the bond market busting up, he had to raise interest rates, you know, to 20% to save the dollar and stop inflation. I mean, those were terrible recessions. You know, a lot of people lost money. If you're not prepared for this kind of scenario, I mean, you have to move your money depending on what kind of cycle we're in. Like today, we're sitting here, you tell people, okay, what's cash worth today in the U.S.? 90-day T-bills. What are they paying? I think they're paying 0.1%. In other words, zero. What's inflation? The government tells you it's 4 or 5, and you know that's wrong, understated. So let's just double that. It's 8 or 10, which is probably closer. So in other words, you, just by holding cash nowadays, you're losing 8 to 10% of the purchasing power of your money every year. Just by holding cash because you're afraid. Like, I don't know what to do, so I'm just going to hold cash. That's not a choice anymore. Like, if this continued on for a couple of years, another year, you could lose 20% of the purchasing power of your money, and you think you're playing it safe. That's not safe.
Is the real rate of inflation likely being understated? I think you just mentioned it is.
Absolutely. Of course it is. I mean, used cars went up 30 to 40% last year. I mean, houses are going up at 11, 12, 13% a year. Food's going up at 10% a year. I don't know what medical care is going up, but I bet you it's going up, you know, near double digits. In other words, what everybody needs: houses, medical care, energy. I mean, gas here in Southern California is close to $5 a gallon right now. You know, a year and a half ago, it was $3.50. Insurance is going up. Everything is going up. You're paying more and more and more for everything. It's not 4 or 5%. It's probably 10%. And you can't get any return on your money. So, in other words, you're forced to be a speculator. You got to put your money in something. You just can't leave it in there in cash and get your brains beat out by inflation.
What has caused inflation to kick in?
That's a really, I'm so glad you asked that. And most people, it's always a combination of things, of course, but most people think it's a monetary event when inflation takes off, when in reality it's a psychological event. All of a sudden people start understanding that the currency is losing value. So they start spending it faster and faster and faster, you know, to preserve its value, which in turn fuels the fire for more inflation. So it's and that's especially true on a larger level, like hyperinflation. Hyperinflation just thinks like, oh, the printing presses went off and they printed up $20 trillion last year. Well, that may be a part of it, but people are looking at it and they're going, our currency isn't worth anything. They can just print it up, and all of a sudden they can't get rid of it fast enough in order to trade it for something that can hold its value, like an asset perhaps, or a business, or a stock market or something like that. Then it's all psychological. It takes off on psychology. That's when hyperinflation goes vertical and goes from like 500% to 4,000% or something. It's all psychology, Jim. It's nothing to do with way less to do than the amount of money in circulation. People get scared crazy and they just don't want to own the currency. And as soon as they get it, they can't get rid of it fast enough. You know, so the velocity just goes through the roof and money's turning over like crazy, you know, pushing up prices. Everybody wants to buy something today at any price because it's going to be more expensive tomorrow. And so, hey, that's the way cycles work. They feed on themselves on both the upside and the downside. And that's a reality of life that is with us today, and it was with us 2,000 years ago. It will never, ever, ever change. And the sooner everybody gets that in their mind that, just because you haven't seen it in your lifetime doesn't mean it can't happen.
Could we be looking at a 1970s type inflation scenario ahead?
Oh, I think so, absolutely. It probably won't be the same, nothing ever is, but I mean, just by the experience of the 70s, during the 70s, it gained more and more and more and more and more momentum, and then it just, all of a sudden, it went to, it just started going vertical. It was up at 6%, 7%, and then at the worst of the worst in 1980 or so, it went up to 13.5%. And that's the government reporting. That's when the Fed had to step in, and how did he save the dollar? He rose interest rates to 20%. I haven't researched what the national debt was in 1980, but I would be surprised if it was even $1 trillion. Well, what is it today? 28 trillion? So all of a sudden, interest rates went shooting up from like 5% to 20% in the matter of 6 months. What do you think that would do to the U.S. Debt servicing? It'd blow us up. We'd blow up. Sometimes you keep painting yourself into a corner where there's no good choices. Eventually the chickens are going to come home to roost. Or, as I like to say, one of my 3 time-proven principles, only 3 time-proven principles in economics is this: there's no free lunch.
When inflation kicked in the 70s, how long did it take for interest rates to start moving higher?
I haven't looked at a chart on that. I mean, it was slow until inflation all of a sudden hit 13%. Well, I mean, what were interest rates? It was common that we saw interest rates. We were paying 10% for interest rates, and inflation was at 10%, and everything was going along just merrily. So it's not high interest rates that kills things. I mean, if you can borrow money at 10% and make money, that's a good economy. That still works. But it was, we paid 10% all the time, and even 11, and even 12. But once Volcker had to start, during those inflationary times, but once the Fed chairman, Paul Volcker, had to raise interest rates to save the dollar, or the dollar would have crashed, the world reserve currency would have crashed, the whole global economy would have crashed. Then all of a sudden mortgage rates went from 12% to 18% in about 6 months.
In inflationary times, are there good assets and bad assets to hold?
Oh, of course. I mean, long-term, long, stock market is probably your best all-around inflation hedge. Real estate, California real estate tends to be a good inflation hedge, not long-term, not as good as the stock market, but certainly better than U.S. real estate. U.S. real estate the last 40 years or so has only appreciated at about 1% above the rate of inflation. So, and then all of a sudden, that's during good and bad cycles. So, if you get into an inflationary cycle, here's what happens. Let's say during the 1970s, inflation was at double digits. Housing prices in the U.S. on a nominal basis didn't go down. Or they didn't go down. They didn't ever go down. That's what people like to say. U.S. housing prices never go down until you adjust for inflation. All of a sudden you start getting to 1980 and 1981, inflation's double digits. All of a sudden your house that was worth $100,000 in 1980 is still worth $100,000 in 1982. Right? Wrong. Because the purchasing power of those dollars fell by 20 or 25%. You're down 20 or 25%. Real world. And a lot of people don't like to think that way. What is it? Is it too painful? Is what happens in the real world that painful that you can't even, look at it objectively?
In inflationary times, do some businesses do well while others do poorly?
Well, I don't know about the ones that do. The ones that do well are people that are in the commodity business. People that like the copper business, the metals business, and that kind of thing. Everybody else, during highly inflationary times, inflation isn't good for anybody. It's bad. It hurts most people. And it hurts most people because incomes don't keep up with inflation, especially in the lower classes, Jim. That's where the problem lies. Yeah, your income went up 10% and inflation went up 13%. So you're down 3% for the year, this year. Next year, same situation. Now you're down 6. A year later, you're down 9%. Call it 10. You've lost 10% of the purchasing power of your money. And people are living hand to mouth anyway. So something's got to get cut out. And that's why they have to end the inflation. I mean, that's why, you know what, inflation makes it really hard to stay ahead of the curve. I mean, and you just can't stay in any, any one asset. And if you get into an area of hyperinflation, which is super interesting, things I've studied, it's, I mean, even, you don't even have to look at Weimar Germany. I mean, go look at Argentina, or look at Venezuela, or Czechoslovakia, or even Russia. Those are some, Russia in the 1990s. Those are some more current experiences that we've had. Inflation can get out of hand real fast, especially when you're running printing presses to pay for things that you really can't afford.
Is inflation good for people who are in debt?
People say, let inflation wear it off. My experience has been no. That debt serves a purpose. Debt serves a purpose to a certain degree, like if you buy real estate at the right time, leverage it, of course, that kind of debt. But overall, I think debt is a risky endeavor for most people because the future's uncertain, their job's uncertain, their income's uncertain, and all of a sudden that debt is still there. You can lose your ass. And you do it when you're young, for sure. That's how we all get started. But especially older that you get. Like, let's say you're in the retired or near retirement age. Do you want to be in debt? No. You don't want to be in debt. Are you nuts? You want to be out of debt. Oh, well, gee, you could be buying some homes down here in California and making, putting 10% down, borrowing 90%, and make, the homes are appreciating at 20% a year. My God, with 10% leverage, you can make 100% on your money in a year or two. No. What happens when the cycle turns? Now you're going to lose everything you have in it and maybe more. So I don't like that. But debt is always, here's when debt is useful. Let's say you've got a good business. You got a good product. You're a manufacturing business. Can you go into debt to finance operations? Of course. But the average Joe, he doesn't own a business or, to do that. He goes into debt to buy a car. Or everything's in debt. I mean, and it's really harder for people nowadays. Really harder for people. Hey, so I mean, and I know that, but it has to be a mindset. My dad came through is a Marine, came through the Great Depression as a kid, and he was a builder for 55 years, developer for 55 years, and he never went broke. Do you think he was reckless with money and out there leveraging money, even though he was in the real estate business? No, he wasn't. And I learned that from him. And he was very comfortable financially. You may not make hundreds of millions of dollars doing that, but you don't need hundreds of millions of dollars to be happy. If you're healthy and good at what you do, have a brain in your head, live in Southern California on the beach.
At some point, could interest rates spike up quickly?
Yes, very quickly. I mean, because it's all psychology. It's all all of a sudden you start seeing the governments, that they're printing up all the, especially government debt. They've abused government debt, sovereign debt more than private debt. But I mean, that's what's most risky because they have a printing press. Like a private debt, if you can't service the debt, you have to default. I mean, at least theoretically. Does anybody ever go broke nowadays? No. Nobody. Everybody gets bailed out. So whatever your loss, whatever money you've lost the last year, just say you were a victim of COVID and the government will write you a check and make you whole. I mean, is that you think that produces wealth for countries? No. Just the opposite. So, I mean, but they can spike up, and they can spike up quickly, especially if all of a sudden, let's say inflation took off, and all of a sudden it got up to 8%, 10%, in that range. I mean, that wouldn't take much of a reach at all, especially looking at things legitimately, and as things are happening here. Okay, the Federal Reserve has no choice but to start raising interest rates. They can't keep interest rates at zero, because nobody will buy. They'll have to buy all the government debt. Nobody will buy it. Inflation's 10%, and 30-year government bonds are trading at a coupon, at a yield of like 2.1% for 30 years, and inflation's 8%. How many? Everybody hold up their hands. Who wants to buy those? Oh, wait, didn't anybody hear the question? Nobody. So the buyer of last resort is the Federal Reserve. Then they end up buying the whole thing, like they do in Japan. So what Japan has to do to hold things together. How's their standard of living? It sucks compared to what it was. nobody goes broke, so they've supported everybody. So it's really interesting if you look at historical things where we may be in the cycle, and also, hey, we may be in the cycle where, I mean, this thing is building right now. You have to respect the prevailing trend. You just can't ignore it and say it's transitory. How the hell do you know it's transitory? Well, you have a crystal ball? What's the existing trend? Which way are things going? It's going up. Yeah, I mean, that's the game you play. You should, as an investor, the game you play is to always be in sync with the existing trend. It's not overthink it and go, oh, this can't go on. You could be, most likely you're going to be wrong. So you got to follow trends. Follow trends, follow cyclical patterns, follow historical patterns, and then that you use all that stuff and use it objectively. That gives you an advantage in the markets, which over the course of a long term should make you comfortable financially.
Is the stock market a hedge for inflation?
Yes. Historically, long term, it's been a good hedge. But if you were, the U.S. stock market during the 70s and early 80s, kind of went sideways to down when inflation was picking up. But over the course of maybe when inflation is high, that, the stock markets, even then, I've studied countries before, even like Weimar Germany, when the mark became worthless, they started burning it for fuel in the house because it was the currency, because it was more efficient at heating than was wood. It's not going to get to that. If it gets to that, then everything just goes, nothing's worth anything. But most likely it won't get to that. But that can happen, and it happens real fast. Hey, we even look at Venezuela. Venezuela, like let's say, and I'm just kind of guessing out loud here. Maybe 10 years ago, the inflation rate in Venezuela was 40%. Then about 6 years later, it was 4,000%.
When interest rates head higher, what usually happens to stock markets?
Well, it takes wind out of the sails because now the stock market has competition. Why has the stock market been going up for like 40 straight years? Because interest rates have been going down for 40 straight years, right? What's the alternative? There is no alternative. But when that trend reverses, yes. But even in high interest rates, high inflation, I know what I want to say. During Weimar Germany, the stock market held its own because society does go on. You need major corporations, big businesses that make things, that service things. In other words, publicly traded companies, they're not going to all go out of business. We'd go back to prehistoric times. They're going to make things at a price where they can make a reasonable profit. And if the people can pay it, they can pay it. If not, there's some casualties. But that the stock market tends to be a good long-term inflation hedge during periods of high inflation. Zimbabwe, the stock, what was the currency exchange in Zimbabwe? Like, did you ever see those notes for like $100 trillion? The stock market did fine. Because you know why the stock market, why these countries exist? So even Argentina has gone through bouts of high inflation and economic crises every 10 years. The U.S. dollar is also the currency that people do business in. Like, if you want to buy real estate, you get a mortgage in U.S. dollars. You don't get it in Argentine pesos. If you want to borrow money, everything's done in U.S. dollar that's serious. You go to the store and you pay in Argentine pesos, and that's what kills everybody. But see, in some of these other things, there's been an alternative currency that you could hide in. So the rich people don't get slammed as bad as the poor people.
In inflationary times, how does the U.S. dollar usually react?
Oh, it does terrible. It does terrible until you raise interest rates, because all of a sudden you're holding a dollar in your hand that in a year later is going to buy 90 cents worth of goods and products. So you got to get out of it. So you have to stop inflation, and to stop inflation, you got to raise interest rates. That when interest rates are falling, it's typically bad for the dollar. When you raise interest rates, it's good for the dollar, because now all of a sudden people can make a higher return in the dollar relative to their own currency. So eventually, at some point in time, when they raise interest rates up to, the heights they had to break the back of currency, the stock market did really, really well. because interest rates were coming down, inflation was coming down, and where it especially worked was for the U.S. government, because all of a sudden they were financing debt, at 15% in 1980, and then, 10 years later, interest rates had fallen down to like 7%, and guess what? They could double the amount of debt on the books, and the annual payment didn't change. How can you beat that, right? And then it fell even lower. Then it fell to 5%. So you could double the amount of money you had, that you borrowed, because the interest rate's so low. And that's the situation we're in right now. Can we do it Japan? Sure, I guess. Where, there's no inflation, no interest rates. Interest rates, like 30-year mortgage rates are like 2% or something. There's no inflation in housing. There's no inflation in anything. It's deflation. But all of a sudden, our country's not built for that, for deflation. It's inflate or die. Inflate or die. So there's so many possibilities. All you can do is just go over them and say, okay, I think this, and come up with a list of probabilities that could happen. And a lot of people are saying, I think there's going to be deflation. And I have a real simple answer to that. Going back 100 years, going back 70 years, go back to when since 1930s in America have you seen a deflationary cycle in the world economy, in any country? And I think the answer is zero. So going forward, do you think that we're going to have another deflationary crash, or is it likely to be, an inflationary crash? Most likely an inflationary. Study history. All these nothing's tied to the dollar anymore, to gold anymore, so they can print as much of this crap as they want. And they will. That's how it happens. All of a sudden they start getting in trouble and go, holy crap, things are out of hand, but, maybe if we just print up some more money for another month or two, everything will get better, and it'll automatically readjust and fix itself. Well, it usually doesn't. And now all of a sudden, so they go, we only have to print up, like, $100 billion a month to keep our ass out of everybody from going bankrupt. Then it gets up to 200, then 500, then $1 trillion. It just slowly gets out of hand, is what happens. That's the experience. Because nobody wants to do anything on their watch which is going to tank the economy, right?
Inflationary times and the bond market, what usually happens?
Well, the bonds get killed. They get killed. So all of a sudden you start getting up to high inflation, it crushes the bond market. Little things like retirement plans and pension funds and Social Security. I think Social Security, 100% of its investments are in U.S. Treasury bonds. So let's say they're owning all these Treasury bonds right now at 2 or 3% or whatever the case may be, and inflation goes roaring, and now all those Treasury bonds are yielding 15%. You know what the value of when they have to sell their bonds to pay out the benefits to the retirees, you know how much money they get? At 15% versus the old 2? About 70% less. So now they run out of money. They can't afford to they can't afford to continue making the payouts.
What does all of this mean for real estate?
It means, there's a time and place for everything. If you get into high inflation, you don't want to own real estate because real estate is a credit-driven market. During high inflation, interest rates go way up. Less people can qualify. And it's safer to be in a friggin' bond, paying 12% than it is in real estate, that has a 4% cash flow. So that's your competition right there. And plus, rates keep going up, and eventually, here's what's really interesting. You take inflation to even more extreme measures, near hyperinflation measures, there is no credit market. Nobody's going to lend you money. If inflation is 1,000%, is anybody going to lend you, what percent are they going to charge you on your home loan? 0, because you're not going to get one. So now it turns into a cash market, Jim. That's the fascinating part. See, that's why I think, and you've seen that in experience before, I think that happened in Argentina over the period of a year or two. During the inflation. All the mortgage money dried up, and the people that had the cash, now all of a sudden the house is worth $100,000 if the borrower can put down $10,000 and borrow 90 from the bank. Okay, now you can borrow zero from the bank. So how much money do you have? $10,000. Maybe that's what the house is worth. Because you can't get a loan. So all of a sudden you buy things at dirt cheap prices until everything stabilizes, and all of a sudden mortgage money becomes available, and your house goes from $10,000 up to $50 or $60 or $100,000 again. But timing's everything. You got to be pretty savvy to pull some of this stuff off, though. But at least you should be aware of it, Jim.
What's the latest on the California drought?
You know what? I don't listen to the news anymore just because it's so boring and it's all political. But I was watching a few things on, in economic things, and I see some of our lakes. Our lakes are way down. There's this lake I never heard of in the middle of Central California that has 112 houseboats on it when the lake's at full capacity. The lake is so low, they've made all 112 houseboats get off the lake. Now, can you imagine, do you think it's easy or hard to get a houseboat out of the lake and onto land? Those things are big, Jim. So I don't know. I mean, but they said you couldn't live on houseboats on the lake. So I think that we're certainly not getting a ton of rain. I mean, that's for sure. It's been more sunshine than anything here in California the last 5 years. So I could see where we could be in another drought situation, or maybe we're using more water. Who knows? But I think water could be a problem.
What's the latest on California real estate?
Oh, it's still cooking. It's still in fifth gear. It's still in fifth gear right now. I mean, we use median price, and California's that California, the three major cities in California, San Francisco, LA, and San Diego, not so much San Francisco, but Los Angeles and San Diego, I mean, we're going up at, 20% a year, median price right now. I mean, is that sustainable? No, it isn't. But there's some things in the air right now that I'm seeing that a lot of buyers are backing away from this market. So it'll eventually show up in the existing home sales, building permits, and other key indicators that I watch. I mean, and for those of you that don't understand what I'm talking about, what my book explains is that you only need to watch 5 key indicators that'll tip you off as to which direction the housing market's going, and with a high probability of success. And so I'm looking for my tails. They're telling me. But all of a sudden now, from a psychological standpoint, for some reason, whether it's COVID related or that the price of housing is too high or whatever the reason, that sentiment toward housing has taken a big dip in the last month or two. Big dip. And it's all about sentiment. If you think real estate's a bad investment, right or wrong, and you act accordingly, that's bad for the real estate market.
How is real estate looking in the rest of the U.S.?
Real strong. It's real strong all over. We're not seeing any cracks. I would be surprised, frankly, if we saw any kind of bad signs before the end of the year. But I have to take that back too. Based on all the key tell indicators, U.S. and California was going into a real estate downturn starting in about sometime in '89, between 2018 and 2019. It was all heading down. All my indicators showed it the same way. Then all of a sudden, the worst flu hit in the world, and everything took off to the upside like a rocket ship. Gee, have you ever seen that before? No. I mean, which all goes to tell you, Jim, it's a riskier place than you think. You just don't know what's going to happen. I mean, would anybody have assigned any kind of over 50% probability of that happening? No. But it did. It happened. So, I mean, the people that didn't sell were all the better off. The people that sold, they may still turn out to be better off, when this cycle finally peaks out and we start heading down, because it's going to be a big correction. It's going to be a big correction when the cycle reasserts itself. And whether it reasserts itself just based on nominal prices or inflation-adjusted prices or both. Because it's all about purchasing power of the money. I mean, it has nothing to do with anything else. You have $1 today, how much does it purchase? $1. Okay, what's that dollar going to purchase next year? 90 cents. You got to get rid of that dollar. You got to put in something that's, even if you put in something where you lose money, but you don't lose as much. You only lose 5% of your money. At least, only losing 5% of your purchasing power versus 10%. I mean, that's a better outcome.
Does it make more sense to buy or rent a place to live right now?
I think that if you can afford it, you should always own your own place, because most people don't look at their home as an investment. Very few people do. It's a place so you don't have to be at the whims of a landlord who's going to sell or want to raise the rent or anything like that. You're in control. Being a renter, you're not control. And I come from the school of thought you want to control as many things as you can in life. So I think owning long term is better. But because everybody needs a place to live, so whether you rent or own. So why not rent the damn place? Own it. You can fix it up. There's certain things you can do, and especially if you buy it right, Jim. My favorite investment strategy is to buy low and add value. Anybody that's followed me for the last 20 years knows that it's not buying high. It's buying low and selling high. But when you buy low, you have so much better choices. Now your house is worth $1 million, and you paid, 10 years ago you paid $500,000 for it. I know. It doubled in 10 years. That's a good investment. And especially when you got your downside covered. You have it at a low price. So all of a sudden prices correct 30% or something like that. Hey, you're still way above what you bought it from. You're not underwater on the damn thing. So at least from a psychological standpoint, you're much more likely to tolerate the pain of losing money on the downside.
What's been happening with car prices?
They're up 30 to 40%. The last used cars up 30 to 40%. Now, new cars is a different story. They're up like 50% or something in that same range. But after the government does all its hedonic adjustments downward, that the new cars have this, so that makes the car more valuable. So you got to back that out of the price. And new cars have this. If you go online and adjust housing prices for all these hedonic prices for all these hedonic adjustments that the U.S. makes to it, the price of a new car hasn't gone up in 15 years, which is, as everybody knows, is complete BS. That's another way they hide inflation. Like, let's say the price of hamburger goes from $2 a pound up to $10. That's 800%, 400% inflation. They go, oh no, that's not right, because you can eat cat food for the same price now, and you can live on cat food. So there's really been no change. You just have to change your eating habits.
In inflationary times, where are the safest places to put your money?
Well, in inflationary times, let's say that inflationary times, a safe haven is money market, and to roll like 3-month CDs, because they keep going up and up and up, and your time exposure to the market, is so you're hedged against inflation. But is gold spiked last time during the inflationary 80s. It went from like $35 an ounce in 71 to or $40 an ounce in 71 to $850 in 11 years later, 10 years later. That was a good place. Stocks didn't do too well that well. Real estate doesn't perform particularly well during inflation. The actual value of it, and you're paying your mortgage off with cheaper dollars. Big deal. Price movements where the money's made, not paying down a mortgage.
How has the U.S. government been able to grow their debt for the past 40 years?
I already mentioned that. Interest rates peaked. Government bonds peaked at 15% in 1981, and now they're down to 2, 40 years later. So all of a sudden you go, how much debt can I service at 15%? And keep the debt servicing reasonable. $1 trillion. How much debt can I service at 2% or less and keep the debt serviceable? It's not $1 trillion. It's like $15 trillion. And that's how it's all about the payment. They just keep refinancing everything and refinancing all their debt at a lower rate, so they have more money to spend and more money to borrow, so they can service more debt. When that trend changes is when we're in a world of hurt. And I don't know how they can prevent it. I guess the Fed can buy inflation can be 10% and interest rates can be 0% because the Fed owns it all. Is that going to work? Something tells me no.
How is gold looking?
Well, up until about 4 days ago, it was looking great. It it was like over $1,900. Now it's dropped to $120 or $130 in 3 or 4 days at $30 a clip each day. But longer term, gold and commodities. If I had to put my money in anything right now and just say, I'm going to leave it there for 5 years, let's say 3 years, and you can't touch it, it'd be in gold and it'd be in commodities. Because I think it's going to be inflationary.
How is silver looking?
Silver looks good. Silver's going to go up with gold. I think gold's going to go up more because I think they're going to have to revalue gold to a big number to save the bond market from collapse and save the economy. Otherwise, nobody will buy bonds. So they're going to back the dollar by gold, and gold's going to be adjusting. So gold's not going to be $2,000 an ounce. It's probably going to be $20,000 an ounce. So if you got gold, that's quite a windfall. You made 1,000% on your money in 3 years.
Fear versus greed, which one is more prevalent now?
The greed. The greed's more prevalent. You can see it in the markets. Everybody's afraid of missing out. We're still in the greed cycle.
What do you have for us on health?
I'll tell you what I've been doing on health, guys, is that for those of you that don't know me by now, I just turned 74 years old, and my goal is to have six-pack abs within the next 12 months. I mean, I've always been in really good shape, but I had six-pack abs until I was 65 because I just worked on it and things like that. But now, all of a sudden, I've got one of my latest projects is to do that, not only for health and fitness, but it's for bragging rights. Because how many people do you know that are 75 years old that are fit enough where you can see their abs? They have six-packs. And it's just that kind of bragging rights. And I know it's super healthy. But I'll tell you one thing, Jim, my goal was to lose 6 pounds to get to where I want to be. The last 6 pounds of fat, now be about 13% body fat, some people say it's impossible to lose. And that they're pretty close to right. So it may take me, guys. I figure I'm losing about 1 pound a month. And I'm doing everything humanly possible right. Eating right, working out right, drinking a lot of water, getting a lot of sleep, everything. And I'm losing 1 pound a month. It may take me 6 to 12 months to get my weight down to where you can see my abs again. That's how hard it is to lose the final pound of fat. But it's a magnificent goal, and that's kind of what I'm most excited about. And what's interesting about it is this: I've developed a whole strategy my whole life. What's the best way to stay strong, stay fit, keep your weight down, and stay happy? Do all those things. And it's not starving yourself, because you can't yo-yo and go up and down in weight, then starve yourself because it's unsustainable. But what I'm doing right now, I'm fasting 14 hours every day. I stop eating at 10 o'clock at night and don't eat until at 12 o'clock noon. I drink half a gallon of water every day, which really helps you. I eat a high-protein, a high-fat diet with low carbs, and I lift weights at the gym so that my muscles stay strong and well-defined, and I run up hills and run in the soft sand at the beach. And let's see, is there anything else? I mean, you got to do all those things when you get to be my age to do what I'm trying to do. And I'm doing them all. And what's the thing I'm most impressed about? One of the things I'm impressed about is that I'm not hungry. So this is sustainable. If I want to keep this going and stay down to, stay lean and strong, for the rest of my life, you could do it because you're not hungry. And the biggest secret of all this is keeping the weight off. Any idiot can go to the gym and lift weights and get big. That's the easy part. Go lift weights, need a lot of protein. You'll gain weight, you'll gain muscle. The thing is to get your body lean, and have a flat stomach. To me, you're not in good shape unless you have a flat stomach. And I know I'm super critical, and I hold my own self to these standards too. That's just the way it is. If you're in good shape, you have a flat stomach. I mean, do most professional athletes, like cornerbacks in the NFL and wide receivers have flat stomachs? Yeah, they have flat stomachs, and they're in really good shape. I mean, that's the way you want to be. So I know I take it to kind of an extreme level, but even if you only get 80 or 90% there, you're 1,000 times better than the average guy out there. You're healthier, you're happier, you have more energy, and all those kind of things. So this is what I'm developing, where it's sustainable. You can't go on these sudden weight loss diets. You can't. There's a TV show here in the United States called The Biggest Loser, where they have people that are like 400 and 500 pounds, and all of a sudden they're in a contest for a year, and the winner is the one that loses the most weight. I don't know if anybody's noticed, but there has never been a reunion of all those winners. You know why?
Some of them are dead.
Most of them have gained all the weight back.
Yeah, it's the most unhealthy way to lose weight.
Exactly. It is unhealthy. But I mean, extreme weight loss, but the thing is, you can't sustain it. And that's the key, guys. Whatever you do, if health and fitness is one of your goals, and it should be, it's always been my number one goal in life, even at the time I was a little kid. What's the point of making money if you're in poor health? There is no point. There is no point to do that. I've had doctors tell me that, medical doctors, they said that they have real wealthy patients, and they said that because I work out with them in the gym, and they said, Bob, I have a lot of wealthy patients. Guess how much of their money that they would trade? And they're all like about your age. Guess how much of their money they would trade to have your health? And I said, all of it? And they go, all of it. And that always stuck with me. So that's how important it is, guys. If you're going to live a high-quality life, the quality of your life is going to be real high. You have to be healthy. So, I mean, that just goes without saying. I mean, you have to do that. Otherwise, you get old and you get sick. That sucks. But so what I'm doing right now is I'm figuring out, and I've been doing this. I'm my own experiment. I've experimented myself and done quite well for the 50 years I've been doing it. But now I've come up with this program based on a lot of science and stuff that can be proven, not only with first-hand experience, but by other things that I'm going to share with people. And I said, look, whether you want to lose 6 pounds or 60 pounds, the formula's the same, and I'm going to show you exactly how to do it. I'm going to, after I've done it myself, I'm going to write up a 20 or 30% page report. Here's what I eat. Here's how I sleep. Here's the kind of workouts I do. I mean, and nothing is crazy, because if it's crazy, you won't sustain it. And so if you stick with this, I guarantee you're going to get in much better shape and stay in better shape and stay in better shape than you've ever been in your life. That's the easy part, Jim. Anybody can tell you how to do it. Now you got to go to do it. You have to do it, and you have to do it consistently. And there's no substitute for it. So it's just one of those kind of things that, I've just developed into, as I get older and wiser and life is good. And, in some ways you want to make yourself more memorable, just for your own sake. So all of a sudden that people don't forget who you are after, 3 days after you're dead. And mine's going to be like, to have a 75-year-old guy that understands real estate economics and has six-pack abs. How many real estate economists do you know at 75 that have six-pack abs?
Any other wisdom you can leave us with?
Nope. I mean, that about covers everything here for today. I mean, the wealth and health, I mean, and they're inextricably, tied together. So, that's it for this month.
Bob, thank you so much for chatting with us.
Okay, bye.
My guest has been Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find him online at realestatetiming.com. He was speaking to us from San Diego. Coming up, Ed Steer next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. I'm speaking with Ed Steer, founder of EdSteerGoldandSilver.com. He's also director of GATA, the Gold Antitrust Action Committee. He's speaking to us from beautiful Merritt, British Columbia. Welcome back to This Week in Money.
Well, good afternoon to you, Jim, and to all your listeners.
This has been quite the week for gold, silver, and the U.S. dollar. What's going on there, Ed?
Well, the Fed spoke at 2 p.m. on Wednesday afternoon, and the dollar started screaming higher. Actually, it started screaming higher 2 or 3 minutes before the Fed spoke, so somebody got the word. So with the dollar index screaming higher, which I consider to be a short covering rally, the big 4 and 8 shorts, who are short just about 50% of the COMEX futures market in the precious metals, took the opportunity to smash gold and silver, all 4 precious metals, into the dirt. And as long as the dollar index is going up, the big 4 and 8 shorts who are desperate to cover their positions are going to beat the precious metals into the ground, and they've been doing that ever since Wednesday afternoon at 2 o'clock. And as you can tell from looking at the charts this afternoon, it's continuing right up into the close, because I see gold's down another bunch of dollars here about 4 o'clock on Friday afternoon.
Could we be at a turning point for gold, silver, and the greenback?
Well, the U.S. dollar is so overvalued right now, and the reason it's overvalued is just like everything else that's overvalued, like the stock markets and interest rates are so low, is that there are really no markets out there anymore. Everything is being managed by the Federal Reserve or by the algorithms at the Fed or whatever. So, as far as a turning point goes, it all depends on what the paper hangers on Wall Street and at the reserves and the bullion banks want to do as far as gold, silver, and the U.S. dollar. They can manage anything up, down, sideways, or whatever. So are we at a turning point? That'll be decided once the big 4 and 8 shorts have covered as many short positions as they can. And then I think we'll see the U.S. dollar start to sag dramatically, and I think that gold and silver will certainly turn back higher, because that's the plan we got. Like you said, there's massive inflation coming, and prices should be going up regardless of that.
Ed, the official inflation rate in the U.S. in May was 5%, and if that's the official rate, we know the real rate's much higher than that. Do gold and silver usually move higher during times of significant inflation?
Well, that's what they're supposed to do if in a free and fair market that wasn't being managed. But as long as I just pointed out, these big 4 and 8 traders who control 50% of the COMEX futures market in the precious metals are stomping around trying to buy as many short contracts as they can back, or cover as many short contracts. They can do whatever they want with the price. But like you said, the inflation rate shows 5%, but everybody and his dog knows it's far higher than that. And it's going to get far higher than that in the future. So once they're through covering these short positions, the short-term pain is rather ugly that we have to live through. But there's no question about it. As inflation starts to spiral really out of control from where it is now, you're going to see all commodities move higher, and that will be led by the 4 precious metals.
Where are we in the seasonalities for gold and silver?
Seasonalities used to matter at one time. Everybody looks at China and India because they're the biggest 2 consumers of gold on planet Earth. And what they used to do as far as imports and buying and stuff like that used to make a fair amount of difference in the market. But that was like 10 years ago, 15, 20 years ago. And there was that seasonality. But now with these 4 big traders in the market covering short positions, the seasonality really doesn't matter. I don't look at it all anymore, and as far as I'm concerned, it can be completely ignored.
How are the junior, mid-cap, and senior gold and silver stocks looking?
Well, certainly after 2 o'clock yesterday afternoon, they're not looking good. And, of course, anybody who's bought stocks on margin or whatever is being blown out of their positions. And, of course, there's a lot of redemptions at mutual funds right now, and various and sundry hedge funds that have been selling these stocks into this market. And, of course, that's driven the stock prices lower, especially the silver stocks in the last couple of days. So, the average person, the mainstream retail investor, is just basically sitting on their hands. But it's, as you know, what happens at the margin that affects all these indices. And right now, the hedge funds and the mutual funds are selling, and that's what sets the price. And until when they're through, that's when the bottom will be in for them. And as far as I'm concerned, it's a buying opportunity if you have the money and the inclination.
Overall, are you bullish on gold and silver stocks this summer and fall?
Oh, absolutely. There's no question about it. As there's a lot of chatter on the internet about Basel III, this banking accord that's coming into effect. I don't know if it's June 28th or June 30th in Europe, and on January 1st in the UK. And there seems to be a lot of consensus out there that this is going to drive gold and silver prices higher, and I'm not disagreeing with that. But nobody really knows for sure. And my position is that I'm just going to wait and see what happens. But certainly this price management scheme, which has been going on in the precious metals since, 1973, when the COMEX first started trading, has been for the sole purpose of keeping commodity prices in line. And with massive inflations, I think Paul Tudor Jones said the other day that, buy gold and buy commodities if the Fed continues with their inflation policies. And there's no sign whatsoever that they're going to cease doing that. So, yes, I'm very bullish. And once we get through this short-term pain, I certainly expect the precious metals and their associated equities to be far higher before the year is out.
What's happening in physical versus paper gold and silver?
Well, I basically already covered that. The paper market is driving the physical price. There's no such thing as supply and demand fundamentals in the precious metals or most other commodities as well. So when you look at the gold price, you're looking at the price that is being set by these 4 and 8 large traders in the COMEX futures market, because that's where all commodity prices are set. So as long as they're stomping around there doing their thing, the people that mine this stuff and take it out of the ground have to take this price whether it represents fair value or not. So, but in the actual physical market, things are radically different. Both on the wholesale level and the retail level, the market is so screamingly tight. It's never been this tight in all of recorded history, but as long as, like I said, as long as these big 8 shorts are stomping around, it's not being reflected in the actual physical price that it should be.
Are gold and silver coins selling for higher than usual premiums?
Very much so, and that's basically because there's just no supply out there. What limited supply there is, it takes time for the various bullion manufacturers that make retail coins like A-Mark and Sunshine and all the other mints that make this retail product. I mean, the demand is absolutely off the charts in both physical gold and physical silver, and they just can't make it fast enough to supply retail demand. So, of course, the premiums are much higher. And, of course, I don't know if anybody's noticed the fact, but the U.S. Mint hasn't produced a single solitary silver eagle, for more than 2 months now, and have only sold about maybe 10 or 15 or 20,000 gold eagles. So they're basically shut down because I'm sure they're not producing because they don't want to exacerbate what is already an extremely tight physical market for both silver and gold. So these premiums are going to stay in place, and I don't expect them to go away anytime soon.
Is the high price for coins an indicator for the future prices for gold and silver bullion?
Certainly. Like I said, if there was true price discovery out there based on supply and demand fundamentals, we'd be looking at a 3-digit silver price now and a 4-digit gold price that, frankly, most people wouldn't believe. But like I said, once these 4 and 8 shorts get through doing what they're doing, I think we're going to see far higher prices, and the ones I'm talking about are certainly going to come true in the future.
How is the gold-silver ratio looking?
Well, it's a funny thing. I track this religiously every day, and it's in my column daily. I post it. But for the last 5 or 6 months or so, despite the price machinations up and down and sideways and whatever, on big up days or big down days or whatever, the gold-silver ratio hasn't changed very much. It's between 67 and 68 to 1, 68 ounces of silver for 1 ounce of gold. And so it's amazing how steady it's been over the last 5 months, despite the wild price fluctuations in the underlying precious metals themselves.
The Reddit gang, the people who drove up AMC and GameStop shares, any chance that they're going to take a run at silver like the Hunt brothers did back in the 70s?
Well, I'll tell you what, they're making a monstrous difference in the retail trade, and in certain ETFs like Sprott's PSLV. They've been jumping in there, and that one has just been going up in leaps and bounds. But it's where they're really being felt is in the retail market, because they're just buying everything that's out there right now. So, are they making a big difference? Yes, at the margin, it's making a huge difference, and that's one of the reasons why we have such a tight retail market. But if they really want to get serious about it, they'd have to go into the COMEX futures market and start buying up contracts there. But this isn't where the Reddit crowd's head is at. So, you know, as long as they keep on doing what they're doing with great enthusiasm, you know, all I can wish them is the very best of luck and just keep on trucking.
How do you feel for the hedge fund managers who are upset that the average guy's getting involved in this kind of stuff instead of just leaving it to the big boys?
Well, that's the beauty of this whole thing. You know, when the free markets are actually working and everybody's out there doing what they want to do, the hedge fund managers starting to lose big on this because they're short these stocks. And then, of course, these Reddit crowd goes in there and runs the price up, and these hedge fund managers and the likes start losing money big time. So, you know, I feel for them, but I really can't reach them, if you know what I mean.
Ed, is there anything new with the Gold Antitrust Action Committee?
You know, we're still doing our thing. You know, Chris Paul puts out a Gata Dispatch, and Bill and Chris and I do our interviews all the time. I know that Chris and Bill are going to be at the New Orleans Gold Conference in October. So, you know, Bill and Chris have been doing this for 21 years, something like 22 years now, and I've been in it for about 20. So, you know, we just keep on trucking. But, you know, 20-some years ago, that's more than a generation now, people laughed at us about the fact that the prices were being managed. And through their efforts and especially through the efforts of silver analyst Ted Butler, you know, it's now mainstream. There isn't a person out there that doesn't know the fact that not only the precious metals being managed in price, but all markets are being managed in price. So it's an open secret now.
Ed, for people who want to know more about Ed Steer Gold and Silver.com, do they just go to the website or do they Google you? What do they do?
No, they just Google my name, Ed Steer, S-T-E-E-R, or Ed Steer Gold and Silver Digest, and it'll pop up in any search engine at all, and you can click on the, I have a free sample column there, and they can read that, and if that's the sort of information they're interested in, they're more than welcome to sign up, and the freight is $100 US per year, and in Canadian funds right now, it works out to about $124 for about 250 columns a year.
Ed, thank you so much for being on This Week in Money.
And thank you for having me on, Jim.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He was speaking to us from Merritt, British Columbia on Friday. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Ed Steer, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Jim, I always like being on the showcase.
Larry, the stock markets took a bit of a beating towards the end of the week. Any concerns there?
Well, I think it's a correction. And, certainly it's affecting the, investors. People are getting, in the mode to sell rather than buy. But I don't think it's a long-term situation. I think it's going to clear up. It's not just the markets, it's the commodities. A good example is gold, which is down around 1760, and from a high of 1900 last week, and copper, which is down to about below 320, and from a high of 360, 370 or something it was last week. But so everything has taken a bit of a kicking across the board, mostly due to the Fed talking about raising interest rates as early as 2022, and which is a showstopper for a lot of things that are happening. Certainly, recovery of the business that's going on in the world that keeps the world ticking, and so there's that to worry about. But I think that in the short term, we'll be out of this situation and moving back up. And I've called a few of the markets recently. I said a V-shaped recovery in March last year, and sure enough, that's what we had. And I talked about that, almost immediately, because I could see this was an artificial situation, that it was a fear of COVID and shutting everything down, which it eventually did. But the markets rallied, and we went right back up again. So, we were down to 10 cents in March last year. We're at just under $1.20 today. And, so that's a big kudo. We managed to get through that. And, like I say, we're well financed, and we have some good financial situations on the horizon. So we are, as far as I'm concerned, I'm not too worried about it. But there's another reason for that, Jim, is that one of the fastest growing areas in the market is going to be EVs, battery manufacturing, and recycling. And we've worked hard to come up with a product that should be appealing to the world out there. It's we pretty much concluded all the work that we had done on the pilot plant, that we had more work to do to maximize the pilot plant, et cetera, et cetera. But then we found that the battery manufacturers were looking for a certain morphology on the at the end of the product, and so we looked into that and decided that we wanted to be at the top of the list. So it took quite a while to get the equipment together and get it ordered, and it looks like we're coming close to getting a final results on the morphology. So that's looking excellent for us. But what does that do for us? Well, what it does is it puts us up alongside of the cathode manufacturers, not just selling to the cathode manufacturer, because that's the way it works is you sell your product to a cathode manufacturer, and they chemically treat it for the final use, and part of that is the morphology. And so we want to be able to compete with the manufacturers, and because the price is actually quite significantly higher for a finished product than it is for selling your cathode material, even though it's 99.7% pure and recoveries are 99.7. Those are all great things. But the real money's made on from the cathode manufacturing side, and so we want to be in on that, and which will certainly significantly increase our opportunities to make money. And we've already pretty much covered off the environmental side with all the work that we've done previous to that. So, we have a circular economy, we have a closed loop, we have nothing that goes back into the environment, and nothing that goes back into the air. So that's what we wanted to achieve. It's been a long, hard road. It's cost a lot of money, and but we're getting close to having achieved all that. And I just wanted the shareholders to know that there's a reason for everything. I mean, we could have hopped off the train a year ago or even 2 years ago and gone with what we had, and probably would have even had a bigger price rate now. But in the long run, it's survival, and it's not just survival; it's a continuity of being able to manufacture the product and sell it. So we've pretty much covered off all of that. There's a couple of questions. One of them was the bioleaching the metals to achieve the results that you need for recycling batteries. Now, I do have experience in bioleaching. We spent $1 million or so on it back in the late 80s because we had an ore body that had a lot of arsenic in it, and we wanted to get rid of the arsenic because the smelters wouldn't take it. And so we did a lot of bioleaching testing with a company that was pioneering it at the time, and it's a hit and miss sort of situation. I don't know. It's probably much more advanced today than it was then, but I'm going to stick with guns. We've already proven what we can do with hydrometallurgy alone. No high heat, no heavy use of energy, and so that's kind of what we want to do. And it's not what we want to do. That was our goal, and now we're getting close to achieving it all. I don't like to see the stock slide, but it's got an effect on the management and directors as well as the investors. So, but I don't think this is a time to be thinking about selling. I think this may be a time to say that there's another opportunity to come up to buy at lower prices. And, it's because, you only have to go to our site to see that what I'm saying is all leading up to what I just said. And, a lot of people don't bother doing their homework on the site. The transparency's there. And or else they could figure out what we were doing. Imagine a couple already have, but I just wanted to bring everybody up to date. The fact that all this work has a rationale, and it only makes our product better at the end of the day and more profitable. The truth of the matter is, we're going through a bit of a crunch along with everybody else. And, I don't see that as, I think that the EV car industry is here to stay, and it's only going to grow. I know what I was going to say. There's, the gigafactories. Man, oh man, I mean, I couldn't leave this conversation without talking about that. I was reading a benchmark article where in 2017 there was something like 3 gigafactories, and today there's, 210 operating or planned, and recently Britain came out with 6 applications to build gigafactories in Britain, and it seems like Europe is way ahead of everybody else when it comes to the aggression of moving these battery manufacturing facilities forward, the big ones. And, we have a MOU with Ilvolt, and Ilvolt is, they've got big plans. So they are designing the plant right now and working on a financing to get it done. But there seems to be a lot of money available for building gigafactories. You're in the hundreds of millions when you start looking at all the gigafactories that want to go in there. Hundreds of billions, I should say. So I think we're in the right place, the right time. We've got our fingers in quite a few pots, and I think every one of them will pay dividends at the end of the day.
Larry, for people new to American Manganese, what's the company all about, and what makes it stand out amongst all the recycling prospectors out there?
Okay, well, we get all kinds of emails from our shareholders wanting to know about this this company that cut a deal for black mass, and this company, et cetera, et cetera, et cetera. We don't want to do any real premature deals until such time as we have a handle on everything that we're doing. And but I'm pretty sure that I really do believe in the old saying of build a better mousetrap and the world will be the path to your door, and that's exactly what we set out to do and what we've accomplished. So I'm not concerned about that aspect of it. I think you're going to start to see some deals being cut with us in the next few months. And, because we do have that sort of interest. We have eyeballs into the whole situation. We know that nobody is using our process. But talking about the company, it's a critical metals company, and we took a process for treating very low grades of manganese, which the U.S. is in dire need of, and taken that IP to another level where we can do battery cell not manufacturing, but recycling, and so that's kind of where that got its roots from. We have a website out there, and if anybody really wants to have a clear look at the company, they should go to the website and do their due diligence. We have only so much time in here because we're a small crew, and to try to explain to every individual what our process is all about when it's all on the site. And that's the whole idea of a site. And I just want to mention briefly that we had a shareholder that made some suggestions about our site, and we've incorporated those suggestions into our site, and it's being worked on as I speak. Now, you can find anything you want at our website, AmericanManganeseInc.com. You can phone the company at 778-574-4444, or you can email me at LREAUGH@AMYAM.com, and we trade on the Venture Exchange under the symbol AMY. We trade on the QB board under the symbol AMYZF, and we trade in Frankfurt under the symbol 2AM.
Larry, thank you so much for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 18th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.